At first glance, last Wednesday's September quarter inflation data might appear to have opened the door to the Reserve Bank cutting interest rates at the November board meeting to be held this coming Tuesday. After all, the headline inflation rate dropped to 2.8% from 3.8% over the year to the June quarter, taking annual headline inflation to its lowest since the March quarter of 2021, and well below the peak of 7.8% over the year to the December quarter of 2022. But on closer inspection, most of the decline in inflation was due to things that the Reserve Bank will regard as artificial or temporary. First, the electricity bill rebates offered by the federal and state governments converted what would otherwise have been a 0.7% increase in electricity prices to a 17.3% decline in the September quarter, which delivered a decline compared with the September quarter of 2023 of 15.8%, rather than a decline of 2.7% as it would have been without these rebates. Now, although they certainly provided relief to electricity customers facing significant hikes in their electricity bills, the Reserve Bank's view is that these rebates are one-off and there'll be a corresponding increase in the September quarter of next year unless those rebate measures are extended, which so far hasn't been legislated. Secondly, in the most recent federal budget, the government increased the Commonwealth rent assistance payment to pensioners and others who are renting in private housing by 10% over and above the normal semi-annual indexation. And that helped reduce what would have been rent inflation of 8.5% to a still high, but nonetheless lower 6.7%. And then thirdly, petrol prices fell by 6.7% in the September quarter and by 6.2% from a year earlier. And the Reserve Bank knows from experience, as I guess we all do, that petrol prices are extraordinarily volatile and can move around by large amounts from quarter to quarter.